Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
Welcome to Bloomberg Tech. I'm Katie Greifeld. Coming up on today's show, Intel shares fall on a report that Nvidia halted tests to use Intel's methods in chipmaking. Plus, a federal judge gives the okay for the Trump administration to move ahead on a $100,000 fee on new H-1B visa applications. What that means for Silicon Valley hiring. And Tesla faces more regulatory scrutiny with a new federal probe over its emergency door release. All that and more coming up. Let's take a look at these markets. It is Christmas Eve. There is no trading volume to speak of, but you can see the S&P 500 up slightly on this Wednesday, higher by about 0.2%. The Nasdaq 100 underperforming. We'll tell you why in just a minute. The Philadelphia Semiconductor Index also green, but really slight gains here. Volatility continuing to drain out of these equity markets. The VIX trading with a 13 handle on this Christmas Eve. Meanwhile, let's get to two specific names that are restraining what you're seeing when it comes to the big tech complex: Intel and Nvidia. Intel down about 1.5%, Nvidia down nearly 1%. Given how big Nvidia is, that is really acting as a weight on the overall benchmarks here. Let's bring in Bloomberg Equities reporter Ryan Vlastelica for the latest on what's going on here. The headline that I'm reading on the terminal: Intel falling on a report that Nvidia has halted a production tests of some of its advanced chip making capacity here. Ryan, what do we know so far?
Hey, good morning. Thanks for having me. So the background for this is that for several years now, Intel has really struggled against the perception that it is falling behind in chip manufacturing, especially to companies like TSMC overseas. Now, there was a lot of hope this year following an investment from Nvidia, following the government taking a stake, that it would be able to better finance this ambitious turnaround program to sort of reestablish its leadership position in chip manufacturing. So this report basically says that Nvidia tried out some of the latest chip processing out of Intel, and it's pausing that. So I don't think this will come as a huge surprise, because there was seen as a pretty significant gap between Intel and TSMC, and the other major chip manufacturers. However, this is probably just enough of a cause for disappointment in Intel, which has really been bid up quite dramatically this year on the back of all this news that it's seen about the investments and so forth.
Right, absolutely. Just to recap, Nvidia itself agreed to invest $5 billion into Intel in September. That followed the U.S. government announcing that it was also taking a roughly 10% stake in the company. So there's a lot of hopes, as you say, for a potential turnaround story here for Intel. We know that they have a new CEO as well, but just give us some context here, how this specific year's performance compares to the last several years of disappointment for Intel.
Yeah. So one thing I would just say is that when Nvidia announced the stake in Intel, they did make a point of saying that there wasn't any sort of agreement that it would be using the chip manufacturing here. But clearly they've been trying it out, they've been testing it, and the fact that they are pausing here is just enough of a, it sort of underlines how Intel has really sort of fallen behind competitors in this pretty significant area. Now, there is still a lot of interest in building out domestic chip manufacturing. Intel has been building a chip here. I believe it's in Ohio. TSMC has building a chip that I think is in Arizona. There's a lot of money surrounding this. The CHIPS Act was involving this. There's a lot of significance here, especially when it comes to issues like national security here. So this is something people are paying a lot of attention to. And certainly if the news had been the opposite and Nvidia had come out and said that it is going to be using Intel, I think that would be a pretty significant game changer for Intel as we go into 2026. The idea that it is really reestablishing itself in manufacturing, I think, would cause a lot of people to reassess the stock and its prospects.
Absolutely. Intel, definitely a story to keep an eye on in 2026. Ryan, before I let you go, you had a great story out on the terminal in the past few days talking about how it's the boring bets when it comes to tech that seem to be working the best this year. Memory chips, hard disk drives come to mind. What are some of the specific names that really stood out in the tech space this year?
Well, Micron especially has been a really big gainer this year. Its memory chips, the high bandwidth memory, that's a pretty significant part of overall AI infrastructure. That stock has, I think, roughly tripled or so this year. It recently had results. Results were very strong. The stock moved up even more. And if you look beyond that, the companies that are, typically don't get a ton of interest, companies like SanDisk, Western Digital, Seagate Technology, makers of hard disk drives, also a part of the AI infrastructure. This is something that people were saying wasn't fully appreciated. Hard to make that case now. Some of these stocks have doubled, tripled. They're some of the biggest gainers on the S&P 500 this year, and it is, a kind of bit ironically in a part of the market that otherwise would be a little bit too dull for most people to be excited about.
Absolutely, Ryan. Really appreciate your reporting this year. That is Bloomberg's Ryan Vlastelica. Meanwhile, let's get a broader look at the tech markets and what investors are looking ahead to in 2026 with IPEC Oscar Deshkaya, Sysquote Senior Market Analyst. Great to have you with us. So I actually want to start where we left off with Ryan. It's really interesting that you think about what really worked in 2025. It was the so-called boring parts of the AI trade. A lot of these, memory disk makers, memory chip makers, that is, in the likes of Micron. I wonder, whether you expect that will be the momentum headed into 2026.
Well, it's pretty much explainable why these memory chips, boring pockets of the market, gain more than the other exciting parts. And one of the reasons for that is that because the AI chip demand was so strong that many manufacturers actually assess more capacity in producing these chips in demand, and they reduce their capacity for producing other and more boring pockets of the market. And that's one of the reasons why what explains actually the rally that we've seen in Sanix and Seagate and Western Digital and the likes. Into 2026, we think that not only that the most boring and undervalued pockets of the market will be in investors' radar, but we will also expect to see actually this technology and AI rally broaden toward the non-technology pockets of the market, because the AI productivity, AI cost efficiencies will also benefit to any other sector out there, including banks, healthcare, industries. And I think that this is going to be the big story of 2026.
Yeah, absolutely. And we don't have much longer to wait. I want to talk a little bit about, what didn't necessarily work when it comes to the overall AI trade in 2025. And it's tempting to talk about that as a monolith. But while memory chip makers seem to have a great year, you take a look at some of these software names. Adobe comes to mind, for example. And it feels like some of these companies just can't get their footing under them. ServiceNow, Salesforce, also examples there. I wonder, what you make of what's going on in that sector.
Well, these companies have come under the pressure of AI. You would expect that making AI tools available to investors would boost their revenue, but it actually had the exact opposite effect on these companies. They have not been able to monetize and sell these AI boosted models to investors as much as they wanted. And actually, the fact that other AI models came to the market to challenge these companies have also been a big problem for these companies. We think that in terms of AI applications, the competition is going to be quite rough in 2026, because there are a lot of AI models. Some of them are going to be winners, some of them are going to be losers, but it's exactly the same story for the big AI applications and the likes of AI, Adobe, for example, or Shutterstock. All of these companies that just integrated AI applications on their product offering will have to face that competition. I think that that's going to be also weighing on the margins.
Yeah, it's a good reminder that there are companies that are doing the disrupting, and then there's companies that the market thinks are being disrupted right now. But I also want to talk a little bit about, what we're seeing when it comes to CapEx. That has remained one of the dominant stories when it comes to, every 3 months we get those earnings report. And we've seen it start to really get expressed in certain companies. Oracle comes to mind, both their equity and their debt. This pressure to see some sort of ROI when it comes to spending. I wonder if you see that pressure broadening out next year, IPEC.
Of course. I mean, since the last 3 months, since the last earnings season, what we have seen is that the shiny headline figures were no longer impressive for investors. They wanted to dig deeper into these reports. One, how are the revenues are being accounted? And two, what's happening with the debt? Is the debt too high, or is the debt being offloaded? Was also one of the questions that investors have been asking and have been worried about. So what investors want today is to see slowing investment until we see return on investment. The problem here with the technology is that if there isn't overspending, the risk is that this technology gets outdated by the time revenues start coming in. So we really think that spending is going to be one of the major issues and major talking points into 2026. And one way to go around this risk is to choose companies that are able to turn this overspending into an immediate revenue opportunity, like the ones that do have data centers, the ones that are actually able to rent their chips out. And in this context, what we see is Microsoft, Amazon, and Google are the three companies that could help investors reduce this risk of overspending in AI.
And Ipek, I have less than a minute with you, but before I let you go, I would love to hear, heading into 2026, what is your highest conviction?
Well, the highest conviction right now is rotation, again, from technology to non-technology pockets of the market. I think it is important to note that the macroeconomic backdrop remains positive for technology stocks as well. So we think that the rally could continue, but it might decelerate next year. And again, the AI enthusiasm will probably move toward the non-technology pockets of the market, toward the sectors that actually do also use technology that could be boosted by AI tools.
Absolutely. That rotation, especially from growth to value, has been fascinating to watch over the past couple of weeks. Ipek Oscar Deshkaya of Swissquote, great to get some time with you. Now, coming up on B-Tech, a judge has ruled in President Trump's favor, upholding $100,000 H-1B visa fees. Some of the most vulnerable companies are in the tech sector, but the legal fight isn't over. More on that next. This is Bloomberg. Well, a federal judge says that the Trump administration can move ahead with a $100,000 fee on new H-1B visa applications. Now, that is adding pressure on U.S. tech companies that rely on hiring foreign skilled workers. Eric Larson, he covers legal affairs and politics for Bloomberg News. Pleased to say he joins me now on set. So, Eric, give us some context here. You know, we tend to talk about tech companies when it comes to these visa fees, but just how exposed is the industry to this potential $100,000 fee?
My understanding from these lawsuits that have been filed and from the data we've seen is that they're pretty exposed. Notably, these companies did not file lawsuits challenging the visa. It was filed by other groups. The ruling we just got was from the Chamber of Commerce. So maybe they're waiting to see where this goes. But certainly the Trump administration and other government officials say that these companies can afford them, even though they do use them quite a bit, and they are pretty exposed. The government simply argues there are plenty of American workers who they could be paying to do the same job, just paying them more.
Mm-hmm. Yeah, I mean, you think about some of these giant tech companies with deep pockets. Talk to us about the public sector, though, when it comes to healthcare and education, because, again, we talk about tech all the time, but these sectors also rely on H-1B visas.
Exactly, and there is another lawsuit that was filed by 19 Democratic attorneys general. Most of the Democratic-led states are part of this lawsuit. It's being led by California, which has the most of these visas are mostly in California. And these states argue that they're suing on behalf of the public sector because of healthcare. They say that they have to look out for the healthcare industry, the residents in their states, and they say that the quality of healthcare will simply suffer because there is a shortage of these skilled healthcare workers who use these visas and won't necessarily be able to afford a $100,000 fee from these hospitals. You know, maybe the companies can afford that, but hospitals not so much. So there's not really a carve out for them, and the hospitals could suffer, according to these states that sued earlier this month. And there's a hearing in that case in February. So remains to be seen how a judge will rule on that aspect.
Well, that's the rub, right? You think about Amazon, Microsoft, Meta, Apple, for example. If they're paying millions of dollars potentially for specific AI talent, a $100,000 fee probably doesn't seem like that much to them. But to your point, you know, if it's a hospital having to pony up that fee, it's a much different conversation. Walk us through how you might expect the legal fight to take shape next, because it seems like there's a lot of different moving parts here.
Sure. So the ruling that we just got was from the lawsuit filed by the Chamber of Commerce in federal court in Washington. That case is essentially over unless there's an appeal. It was a summary judgment. The judge, who was an Obama appointee, by the way, just ruled flat out that the government was correct. The president had broad authority to issue this under the powers given to him by Congress in the Immigration and Nationality Act. But the lawsuit filed by the Democratic-led states, that is, like I said, there will be a hearing on their motion for an injunction against the visa in February. There isn't a hearing set on the third lawsuit, which is filed by unions. So this could take months to play out. And as with so many of the other legal challenges involving the president's policies and executive orders, it could end up at the Supreme Court, and that could be quite some time. The big question for employers and potential visa holders is whether or not this program, this fee, will stay in place during the entire legal challenge. Right now it is, but these other lawsuits could result in different outcomes.
All right, Eric, really appreciate your reporting. Great to see someone else in the office on Christmas Eve as well. That is Bloomberg's Eric Larson. Meanwhile, another story that's tying together tech and politics is that the Trump administration has imposed visa sanctions on former European Union Commissioner Thierry Breton, along with 4 other activists who have pushed for regulations to online content moderation. Now, Secretary of State Marco Rubio said in a post on X, quote, "For far too long, ideologues in Europe have led organized efforts to coerce American platforms to punish American viewpoints they oppose. We stand ready and willing to expand this list if others do not reverse course." For more, let's go now to Bloomberg's Laura Davison live in Washington. So, Laura, first, give us the reaction that you're seeing and hearing. Was this move necessarily a surprise?
This move was a surprise and really came as a shock to both the people who were the subject of these visa sanctions, as well as to other European officials, both at the EU level and at individual countries. There's been a really strong and forceful pushback saying that this is a move that amounts to censorship and is very inappropriate on the U.S. side. This is, sort of just one prong in what has really become a multifaceted Cold War between the U.S. and the EU, particularly as it relates to tech companies and who has the power to regulate and tax them.
Yeah, and we talk about this censorship potentially of American viewpoints. What specific platforms was the Trump administration holding up as an example where censorship actually did take place?
Yeah, so there's a couple different here, largely the big social media platforms, so Facebook, Instagram, and X in particular. Elon Musk's platform has been the subject of a rather large fine earlier this year for not allowing these content moderation to feed out hate speech from the platform. X had to pay this fine. This has kind of become this ongoing tit-for-tat war of and you could almost see these visa sanctions coming from the U.S. as a response to that fine earlier this year.
All right, Laura, really appreciate the update. That is Bloomberg's Laura Davison joining us from Washington. Now, coming up on B-Tech, we speak with Stephen Wolf Pereira. He is the CEO and founder of Alpha on Warner Brothers' potential sale. That conversation up next. This is Bloomberg. Well, as Warner Brothers Discovery and Paramount weigh their next moves, media deal-making is back in focus. Joining us now is Stephen Wolf Pereira. He is CEO and founder of Alpha, an independent AI governance intelligence firm for board directors and C-suite executives. Great to have you with us, Stephen. So let's talk about Warner Brothers. You had Larry Ellison coming out with his personal guarantee of $40 billion for the Paramount Skydance hostile bid, that is. Do you think that goes far enough to address some of the Warner Brothers board's concerns about financing?
So it's great to be here. Happy holidays. But this is really going to be a gift for the Ellisons, because if you think about what they are doing, they are truly amassing one of the biggest and most important collection of media assets in record time. And, whether $30 a share is going to be enough, I think they're going to have to sweeten the deal. But I think you need to look at this from a larger vantage point, because if you really look at the assets that they're starting to consolidate, it really is concerning on the one hand, exciting on the other. But when you think about Paramount combined with, potentially TikTok, obviously Warner Brothers Discovery, you just look at all the different pieces of this puzzle. We're really seeing the reshaping of the American media landscape right before our eyes.
Well, let's talk through some of the concerns here. As you said, it's exciting, but there's also concerns. In highest order, what would you say tops the list?
I mean, one is just really trying to understand what really is going to be the governance implications of this.
Right.
When you think about the amount of data that they are now going to have to be able to train all of their AI, again, this is not just a media company. Obviously, Larry Ellison with Oracle, understanding the TikTok angle, this is really connecting the dots, and all of these AI companies are desperate for more data to train their models. And so when you really look at this, this is a truly incredible opportunity to consolidate data all under this massive umbrella, which is really going to be Skydance, Paramount, and Oracle.
Interesting. So you're saying that Oracle, if we actually see Paramount, Skydance be able to win the Warner Brothers Discovery bidding war, that Oracle might then potentially use their content library for training for their models?
I mean, again, you have 100% control over Paramount. What's to say what is the control going to look like, for Warner Brothers Discovery once it's under that umbrella? You're just going to have a lot of ability to kind of blur the lines and just really see who is going to be able to have some type of guardrails, governance, guidelines around all of this. And I think that that's something that shareholders need to look into. Obviously, you want to have, your fiduciary responsibilities as a shareholder, but certainly the board is going to have to make some really tough decisions. And I think there's a really interesting reason why the board has actually rejected the Ellisons repeatedly until they had to go public with this hostile takeover.
Yeah, it is a fascinating situation where you have the Warner Brothers board saying that, we recommend the Netflix offer. At the same time, you have Paramount basically going directly to the shareholders with this tender offer. I mean, what do you make of it? How do you see the investor base actually swaying here when it comes to what the board is saying and what Paramount is saying?
I mean, look, the truth of the matter is you have a very diluted shareholder base. Obviously, you're going to have the large institutional investors, the BlackRocks, Vanguard, State Street, really controlling a lot of the shareholder count. But when you really think about where investors are going to be, they're going to really vote for what is going to be the best return for them. And so I think you really are going to see Netflix really trying to have to up the ante. They obviously have a very clean, kind of approach. They have a very clean deal. Obviously, have a better credit rating. When you think about what the levered company is going to look like combined with Paramount as well as Warner Brothers Discovery, I think it's going to be north of maybe 6-7 times, debt to EBITDA. So just from a capital perspective, it's going to be an extremely levered asset, but that's part of the reason why Larry Ellison is doing the personal guarantee.
And Stephen, we have less than a minute here left with you, but when you look into your crystal ball, how long do you think this saga will continue? How long will it take to actually get a conclusion here?
I mean, obviously, they pushed out the shareholder vote down to January 21st. And then you're going to have, obviously, all of the regulatory, kind of theater that you're going to have to go through. But I feel like this is just the beginning because this is now the reshaping of American media. And when you really understand what is happening, this is a data play. And when you really connect the dots, this is truly going to reshape the way that all the AI companies are going to be able to have access to data, who is controlling that,
right,
and what are the governance guardrails around it.
All right, Stephen, really appreciate your time. That is Stephen Wolf Pereira. He is the CEO and founder of Alpha. Now, coming up, we'll be speaking with Sylvia Jablonski from Defiance ETFs. That conversation up next. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Let's take a look at these markets on this Christmas Eve. The S&P 500, a little bit of green on the screen. As I said at the top, no trading volume to speak of, but you can see we're drifting about 0.3% higher. Tech not quite outperforming today. The NASDAQ 100 higher by just about 0.2%. You can see the Philadelphia Semiconductor Index a little bit below that as well. Very quiet, though, when it comes to volatility as measured by the VIX. You can see we are down about 47 vol points and trading with a 13 handle. Let's talk about why you can see the NASDAQ 100 underperforming. A lot of that comes back to Nvidia and it comes back to Intel. Reuters reporting this morning that basically, Nvidia has halted a test to use Intel's production process to make advanced chips. That is adding to pressure on Intel, down about 1.4%. Nvidia shares also in the red as well. For more on this story, let's bring in Bloomberg Television Markets correspondent Nora Melinda, sitting to my left. So, Nora, what do we know so far about this so-called 18A process?
Well, the fact that Nvidia is halting using Intel's 18A manufacturing process, it actually is concerning for a lot of investors because we know that this is critical to Intel's turnaround story, especially as it tries to scale and really compete against the likes of, say, TSMC. They are a global competitor, and people are really concerned right now as to whether or not Intel is really able to display the fact that it's able to keep up in this space.
And so talk to us about the Nvidia of it all and how it comes in. We know that Nvidia agreed to invest $5 billion into Intel. to September. So how are the two companies' fortunes kind of aligned here?
Yeah, it's a bit of a complex relationship between Nvidia and Intel, because it's not that Intel is necessarily Nvidia is not necessarily a customer of Intel. Nvidia actually works primarily with TSMC. But the fact that Nvidia was able to test out the 18A from Intel, people are really seeing this essentially as a marquee player in the mix, actually co-signing this company and essentially giving more legitimacy, validity to a name that we know. We've seen the U.S. government coming in trying to back, taking a 10% stake in this company, as we're really trying to see more production in the chip space here in the United States.
And what sense do we have of why, Intel and the market in general is reacting in this way to this news? It seems to be some sensitivity here, even though there wasn't necessarily a contract between these two companies.
It wasn't necessarily a contract between the two companies, but this still raises doubts about the fact of Nvidia stepping away from this partnership here, especially because investors are looking for proof that Intel can essentially attract top-tier customers. So that's what's really key here in this moment. The Nvidia name is what's really helping to elevate Intel in this moment. And to see Nvidia potentially stepping away from that test run of the 18A manufacturing process is essentially giving investors some concern.
All right, great reporting, Nora. I'll be seeing you in just about 30 minutes time. Nora and I will take you through the close, this early close today from 12 to 2 p.m. on BTV. But let's keep this conversation going right now, because 2025 has been a landmark year for ETFs, with actively managed funds taking the baton to surpass passive funds for the first time. Let's bring in Sylvia Jablonski. She is CEO and CIO over at Defiance ETFs. Sylvia, great to talk to you on this Christmas Eve. And it's certainly the case that active ETFs have been on fire for the past several years. 2025, no exception. And we're seeing a lot of activity, a lot of interest from investors in these leveraged single stock ETFs, which do count as actively managed products. We know that Defiance, of course, is involved in that space. Talk us through, how you see that interest evolving, if at all, in 2026.
Yeah, hi, Katie. Great to be with you today, and happy holidays, Merry Christmas, and Happy New Year. I think, it's been a stellar year for levered ETFs in general, both index-based and single name funds. We've seen billions of dollars of assets flowing into those funds. And to your point, to active funds. And so what I think has happened over the last couple of years, and you and I have talked about this a bunch, is, we went through this period of time where it was all passive, and a lot of the ideas that were coming out resembled the others. So there were a lot of Me Too products out there, whether it was thematics or anything else. And really over the last 2 years, we've seen a lot of innovation, and we've seen that in single name levered stocks, and we've seen that in options-based products. So a lot of single names that pay income, for example. And I think that, you've seen huge amounts of growth in that because investors were looking for that, right? And so what I expect to happen in the next couple of years is to see that transition with new and exciting names coming out in the single name levered space. Some of the new, picks and shovels of AI, for example, quantum names, some of the themes that are really popular and growing into the next year. And then I think we'll see other things grow out too. I think we'll see new thematics as some of these AI themes, quantum themes, infrastructure, anything related to the advancement of tech really kind of change and grow. So investors are getting very comfortable with ETFs, and I expect that to continue.
And stepping back a bit, I always wonder, if you're managing a stable of, single stock ETFs, that some will probably take off, be very popular. There are certain names that retail investors in particular just seem to gravitate to. At the other end of the spectrum, there's some names that, probably aren't going to garner that same interest ever. And I wonder, as an issuer of ETFs, do you basically just hope you get a few hits when it comes to the single names and hope that sort of subsidizes the rest of the lineup, which may or may not take off?
Well, I think as an issuer, we do a lot of due diligence on this, right? We research the names that we're interested in launching, and we kind of look and see, what is their beta, what is their sort of volatility score, what kind of interest there is in social media, what kind of interest there is amongst institutional clients, what kind of interest there is just in general, media, press, research on certain topics. So we do a lot of work before we actually bring a product to market. So we have high conviction in everything that we're launching, as I would think most ETF issuers do, right? To your point, some of them just don't hit, and and that's disappointing. But the way we view this is, we essentially just move on and just try to make sure that we're capturing the right trends and the right themes that investors are looking at. And if products, if some products are unprofitable, then that's a result of this moment in time, and it can always change, right? We've seen products that sat for 2 years and did nothing take off 3 years later. So
yeah,
all changes.
No, it's a good point, and I think Bloomberg Intelligence has some unofficial Lazarus list where a name does nothing for a couple of years, an ETF does nothing, and then all of a sudden it rises from the dead, if you will. But in any case, I do wonder, when we talk about themes, obviously AI has been a big theme when it comes to equity ETFs, but then you think about what's happening in the bond markets right now, and sort of the AI debt deluge, if you will, has definitely emerged as a theme when it comes to credit markets in 2020. Would you ever consider launching a fixed income thematic ETF, or is that something that maybe there just isn't a market for?
Well, I think that there could be a market for different fixed income products, and I would suspect that issuers such as ourselves are doing research in the space, and there could be some opportunities there. It's something that we're always looking at, and I think to your point, yes, there is sort of that debt issue with AI. There's also a concentration issue growing with AI, right? I think a lot of the big ETFs are out there in the space. But I actually think there's more to come. You saw on December 20th, actually, the Trump administration just announced that they're going to be putting a big agenda and a big priority on researching and building out 6G so that the United States has leadership in that space, right? And so that's an area that we're super excited about. Like, we have a 6G ETF, and that hasn't been talked about, to the point of like ETFs being popular at different times. 5G was all the rage, and here we are now, we have to focus on this because of our AI build out and because of our quantum build out. And so, there's always different directions to grow in terms of thematic ETFs, whether fixed income or equity based.
Well, let's talk about one ETF that did get a lot of interest of yours in 2025, and that was your quantum ETF. The ticker there is QTUM, and it saw a pretty steady stream of inflows all throughout the year, but especially starting in about midsummer or so. When you think about the quantum space and the different names that populated, what is your view heading into next year?
Yeah, so the view on quantum is kind of very much the same, and it's evolving. We view this as a long-term investment, and in the last year, I think the reason that we've seen so much interest and so much inflow into the space is because you've started to get these proof points of reality and commercialization, right? Whether it was the bond pricing example with HSBC, or some of the big kind of quality balance sheet Mag 7, or just large tech companies like IBM and Cisco and Oracle, in addition to the Mag 7, investing in this space and producing products there, and having quantum services available through clouds and Amazon and things like this. So I think as it becomes more commercial and scalable, and proves itself as a technology that investors are really buying into, you could potentially see some performance in those names. But I do think it's like AI, right? It's very much in its infancy. AI is maybe a toddler. Quantum is still just learning to call, right? So it's a long-term buy and hold, and I think that investors understand that, and they're in it for the long run.
Yeah, it is really interesting. I feel like quantum, it's just starting to get socialized right now. But as you said, I don't think it exactly knows how to walk yet. But Sylvia, I mean, you make the point that this is a buy and hold investment. When it comes to your lineup, and you have a broad array of funds ranging from quantum, which of course, as you say, is buy and hold. And then you have, again, those leveraged single stock ETFs. What is the profile of the investors coming into your lineup? Is it safe to say it's broadly retail?
It's not necessarily broadly retail. There's a good mix of retail and institutional clients. What I would say is there are different risk profiles for our clients. So clients that are in the thematic products tend to be long-term, conservative, buy and hold. looking to allocate to their portfolios for longer periods of time, whether institutional or retail. In terms of the single name stocks, it tends to be sophisticated, whether it's an institution or it's a retail day trader. It's a sophisticated trader who understands that these are meant to be traded and not held, that you're getting return for a period of time, not beyond one day, and kind of user beware and understand how these products work over time. And so it's just a different risk profile, but there's a mix of both types of clients, retail and institutional, across all the product suites.
All right, Sylvia, great to get some time with you. Happy holidays. That is Sylvia Jablonski of Defiance ETFs. Now, coming up on B-Tech, we'll discuss the outlook for Tesla. Its share price has been on a tear, but what challenges await in 2026? Steve Wesley, founder of the Wesley Group, he joins us next. This is Bloomberg Tech. Well, Tesla has had quite a year. Its shares have soared. Its CEO secured a record pay package. Its robotaxis launched in a limited way in Austin and San Francisco. But on the horizon are challenges, among them declining sales, shrinking profits, and moves by global regulators. Sources telling us here at Bloomberg that the company is facing a new U.S. government probe over the door handles of its Model 3 sedans. Steve Wesley, he is a former Tesla board member and managing partner of the Wesley Group, joins us now. Steve, great to have you with us. Let's start again with these door handles. We have had a months-long investigation over here at Bloomberg. We know that the NHTSA has opened an investigation in September, and I wonder what you make of how this is evolving and the reputational damage that this could inflict on Tesla.
Look, it's a serious issue, but a lot of other auto companies have had similar issues: Ford, Volkswagen, General Motors. But it's not a simple software fix. So here's a time where Tesla's really got to be firing on all cylinders to fix this.
And I mean, from what you can tell, the company's public posture, do you think that they are treating this with the appropriate degree of seriousness?
Well, we'll see. This is not a simple software fix. So they're going to have to go in, re-engineer some things. The cost is probably going to take a while, but it's not the first time it's happened. It's happened with other auto companies. But I think everybody in the sector is going to be focused in on this one. Tesla, as you know, has had some other brand challenges, so they want to come out. They're trying to position themselves and look like a technology leader, not just an auto company. Fixing this would be top of that priority list.
Absolutely. Well, let's talk about the year for Tesla more broadly, because shares are up about 19% on a total return basis. We know that that has come with a lot of volatility. You think about where we stand right now. Sure, shares have surged in the past few months, but sales continue to be an issue. You think about the U.S., you think about Europe. You mentioned that Tesla wants to be positioned as a technology company here, but this feels like a pretty fundamental issue that is going to need attention.
Look, this is a huge issue. In 2026, it's going to be a pivotal year. Share price at record highs, $1.6 trillion market cap. That's astonishing. But Tesla's likely to see its second year in a row of declining sales and shrinking profits. So the robo-taxi approval they just got in Austin is great. They no longer need drivers in the cars. That still leaves them way behind Waymo. So Tesla's really got to get into a higher gear on regulatory approval. They've got to get into more cities faster, and they need to get revenue growth to keep that share price up. Let's see how well they do.
Yeah, absolutely. I mean, you mentioned Waymo, and you think about the gap. Waymo obviously has that first mover advantage. Tesla trying to close it here. Do you think that that is actually achievable when you think about how far out Waymo is and all the different markets it has already entered?
Well, it's going to be tough for Tesla to catch up because, look, Waymo's already in 6 cities, operational, large cities: San Francisco, Los Angeles, Phoenix, Miami, Atlanta. But they've announced another 16 cities they're going into. They'll do 12 million to 14 million rides by the end of this year, next week. But next year, I think they're looking at a number close to 35 million. They're already making plans to go international. They're doing trials now in London, Tokyo, New York City. Waymo's got a huge lead. Tesla's got its work cut out for it to catch up. If you're positioning yourself as a technology company, they've got to get in the race and go toe-to-toe with Waymo.
And Steve, we've got just about a minute left. We've talked about door handles. We've talked about sales. We've talked about the robo-taxis. What else should Tesla be focusing on in 2026?
Well, I think there's 2 things. The key one is their energy division is booming. And say what you want about, Tesla needing new models and maybe being behind in full self-driving, but every auto company in the world today is also an energy company. And Tesla provides three products: Powerwalls, you've probably seen them in garages; Megapacks, energy blocks for utilities. The takeaway is there's a revolution in AI and data centers, forcing utilities to look for new power suppliers. Tesla's filling that void. Their energy division will grow from 10 billion in 2024 to, I think, about 14 billion this year.
Right.
If they can continue to provide 40% year-over-year growth, that's going to help.
All right, Steve, really enjoyed this conversation. Happy holidays. That is Steve Wesley. He is CEO of the Wesley Group. Now coming up, ServiceNow's big push into cybersecurity, acquiring startup Armis in its largest ever deal. We spoke to the president and COO, that is. We'll bring you that conversation up next. ServiceNow reaching an agreement to buy cybersecurity startup Armis in a cash deal valued at $7.75 billion, marking its biggest acquisition to date. I caught up with ServiceNow president and COO Amit Zaveri yesterday. Take a listen.
When we saw this opportunity and seeing the way that AI adoption is going, this is a great opportunity for us to continue expanding in our security space. So today, our security business has crossed $1 billion at ServiceNow. And addition of Armis will allow us to now get into more new capabilities which customers are demanding from us, as well as allow us to really be differentiated as we add AI, data, workflow, with all of it being around security and making sure there are no breaches customers have to deal with. So that's really the thinking. And Armis is a very innovative company, very well regarded, great team, very good domain expertise. And the combination of us and them can really change the game in the cybersecurity space and build the cybersecurity automation capabilities very fast.
It gets to this idea, too. I mean, you mentioned sort of the potential addition to revenue. I think they talked about a $300 million run rate right now that they're sort of dealing with. This isn't obviously just about the additional revenue that you get specifically from Armis. I assume this is also about bringing in new clients and, more importantly, keeping the clients you have there.
Yeah, this is a very strategic play. I mean, we are very confident about our own revenue plans, right? We don't depend on Armis to deliver our 50-plus, rule of 50-plus, right, which is 20+% subscription revenue growth and 30+% in terms of having free cash flow margin. So we've been 50-plus for the last 10 years, and we keep on delivering that. And we're not dependent on Armis to deliver on what we have been sharing with the street. So this is much more of a strategic play. They are $340 million in revenue already, growing at 50%. But the key thing is the technology and the IP we're bringing in together with ServiceNow capabilities, as well as a lot of the joint customers we can go together with and really provide them a full capability around cybersecurity and help them with all the issues they're dealing with from one platform perspective, right? They have Armis has a lot of data around all the assets company has, the physical assets. If you look at now, physical AI is coming into play as well, robotics and other things like that. That information combined with our ServiceNow's configuration management database, which has assets around software and hardware, we can really give you a full security posture management and really give you the exposure guarantee that nothing can go wrong.
And I want to talk about your deal-making posture overall, because we're talking about Armis today, but you rewind the clock to March, you struck an agreement to buy MoveWorks for about $2.85 billion. Should we expect to see more M&A from ServiceNow in 2026?
No, I think we have all the assets we require. I think this is an opportunity for ServiceNow to really get into spaces where customers are asking us to get quicker. So roadmap acceleration plus scaled capabilities we require. But I think we are very confident with all the things we have announced so far as the core things we require from our portfolio perspective and acceleration we need to do. We always can continue doing what we've been doing before around tuck-ins and small IP purchases. But from the security perspective, I think we have what we need to become the premium security platform provider in the market today.
That was ServiceNow President Amit Zaveri. Now, before we go, it's time for Talking Tech. First up, Bitcoin missing out on the Christmas cheer, currently trading around 87,000 today. That comes after a brutal sell-off in October, saw it knocked from record highs. Token on track for its worst quarterly performance since 2022. Plus, ads could be coming to ChatGPT. OpenAI is said to be working out the details to integrate ads into its AI chatbot, according to a report from The Information. And Alphabet's Waymo said it's updating software across its fleet to better handle power outages. The move comes after self-driving taxis froze and caused a traffic jam during major power failure last weekend in San Francisco. That does it for this edition of Bloomberg Tech. Don't forget to check out our podcast. This is Bloomberg.